Okay, welcome everybody to today's webinar, Pension Standards, Pitfalls and Planning Opportunities. So what I want to do with you today is run through a number of pension elements that we need to consider. And being that it's July, it's a good time of year to focus on these issues early so that that we're not scrambling towards the end of the year. So what I'm going to do in our last webinar, both Josh and myself talked about a number of pension opportunities. So I'm going to revisit those as I work through some of the key issues around the pension standards. And then what I'm going to do is highlight, I guess, all of the problems, and not all the problems, but the problems that can occur with regards to pensions, and then the options that people potentially have with regards to fixing up those issues if and when they do occur. But of course, the primary objective is to ensure that we don't run into these problems for our clients. So as always, have our disclaimer to state that everything is based on the current set of circumstances, and if anything else changes, obviously we need to keep on top of that. And it's an interesting space, this, with regards to whether anything is going to change in the pension environment, because one of the rulings that I do, or the ruling that I focus on today, is tax ruling 2013 5, when a pension commences and when a pension ceases. And that ruling has been under review since 2017, when we had the introduction of the transfer balance cap. So, you know, we know that we've got a current set of guidelines from the ATO with regards to pensions, but it is a little bit of a moving beast in that we've seen a lot of announcements made by the ATO via their website that have subsequently in different stages been removed. So there is still some question marks around how a number of the pension rules work, with references to potentially failing the minimum pension. But also there's some sort of an update that I can give you on a couple of determinations that the ATO released last year that we haven't got finalisation of now, but we do have a bit of a case update. So there's some case law that came out in April that highlights probably the position that the ATO are willing to take, or at least willing to take, in the worst case scenario when self-managed superannuation funds do the wrong thing with regards to accessing their superannuation benefits. So there's a fair amount to get through today. I am a little bit croaky, but I'll work through that. There's a fair amount for us to get to. We're going to talk about the impact of the failing the minimum pension obligations there. We're going to talk a little bit through the concept of withdrawals and lump sums versus commutation, so pension versus accumulation. Again, that's the strategic element, and then can potentially lead to other things that we need to take into consideration. The concept of multiple pensions, and again, what the ATO's position is with regards to such things along the lines of failing the minimum if you do have multiple pensions, and so really taking a bit of a practical look as to how we can work through those issues. So as you can see, there's a fair amount that we're going to get through, and so if you've got your questions, please put them in the Q&A box for me, and I'll endeavour to get to them as they are asked, or failing that at the end of the session. So let's jump into look straight at the pension standards and some key considerations with regards to us paying primarily account-based pensions. And you know, let's be pretty clear. I'm not going to focus on compliant pensions or market-linked pensions with regards to this session. Whilst there are different rules in place for those, the vast majority of self-managed super funds are operating in the account-based pension zone. So that's what we're going to focus on today. So what we know is that the SIS regulations outline the pension standards and our requirements for what we need to do with regards to the running of a pension. Now, these pension standards are actually relatively minimalistic in regards to our guiding principles for paying pensions. So really, for how your clients operate their pensions, you're going to be reliant on the governing rules of the fund, any additional pension contracts that might be set up with regards to when those, the various documentation platform that you might actually use. So the SIS Act really only gives us the basic principles. The Tax Act is where all of our tax elements come into it. And the ATO, from a regulatory point of view, are primarily focused on the Tax Act side of things. So we need to be sure that to get all of our tax exemptions, our necessary tax exemptions, one, we meet the conditions that set out in SIS, and then we meet all the requirements that the ATO want us to with regards to the various tax implications as well. So the first one is that we can't, and these rules applies to all pensions, is that we can't add any capital by way of contribution or rollover. But of course, since 2017, the tax office have issued in 2018 their regulatory bulletin about the use of reserves in self-managed super funds, and they made it abundantly clear in that document that you cannot make an allocation from a reserve to a pension account. So unless it's a defined benefit pension and that reserve is set up to pay and fund the payments of that pension, in the sense of account-based pensions, we can't make allocations to a pension account. So if we do have a reserve, any allocation is going to go to a separate accumulation interest. Further, that if we take any money out in addition to the pension payment, so if we take a commutation from our pension, we have to do that commutation in accordance with Regulation 107D. So I'm going to work through some of the issues associated with 107D as well in the session. Then we go to our 106(9)(a), which is effectively our account-based pensions as they apply from the 1 July 2000 and actually 2007, but certainly in the instance of transfer balance account and that since 2017. Now the key here is firstly that our payments must be made annually. So the first requirement is that we have to pay the pension annually, and the payments excluding commutations. So again, if we're looking at the concept of taking commutations, be it that in specie or whatever it might be, if we're taking a commutation, that amount is not included in the pension requirement. Now, I emphasize that because for many people, depending on how long you've been in the industry, that rule has flipped a couple of times. So before 2007, commutations did not count because we didn't have account-based pensions, we had allocated pensions. And anything you took as a lump sum would not count towards your minimum back in that particular time. So we have to make sure that we understand that now, since 2017, those lump sum amounts don't count towards the minimum. So for a 10-year period from 2007, 2017, lump sum commutations counted towards the minimum. They no longer do. The pension is only transferable to another person on the death of the primary beneficiary. So again, we've got our Regulation 621, which outlines who we can make that payment to. So primarily the spouse, very limited circumstances, we can pay a pension to children, primarily those children that are under 18 or under 25 and financially dependent, or if the child is under a disability. So they're your primary reasons or primary conditions for paying a pension to somebody else. And I guess the world of reversionary pensions, and I'm not going to focus a great deal on them other than when we talk about the pension requirements for failing the pension requirements with a death benefit. Reversionary pensions, I think, are also going through a bit of a sea change in that as well. So we're seeing with things like the transfer balance account, we're seeing things with like the $3 million superannuation threshold that it's really making us sort of stop and think through the concept of reversionary pensions and their value from a taxation point of view to that beneficiary. So again, a lot to contemplate strategically, but for a lot of people, the strategy will still apply that in their vanilla self-managed superannuation fund, they commence a pension, they revert it to their spouse, and their spouse receives it on their death, and there's no other issues. But subject to circumstances is going to determine whether or not the reversionary pension is the right option. And the capital value nor the income can be used for security and borrowing. So there are basic set of rules that apply to all account-based pensions in the super fund. And so it's important to recognise that we're now in a position that those conditions set out in Schedule 7 for the minimum payment obligation, we're now resetting those to our pre-COVID legislative factors, which is our 4, 5, 6 and ongoing percentages there. So that in essence is really one of the reasons why I wanted to run this session. And that is because we're now in the environment where people have been operating under a 50% pension discount for the last 4 years. And so have they made adjustments to their monthly pension payments from July? And if they haven't, what are the ramifications if they don't make that catch-up payment? And so I'm going to work through those ramifications as we go through the presentation. So that's our SIS pension standards. Then we move into some of the elements from the ATO. And when it comes to starting an income stream, we need to know what the income stream is. And the tax office have provided us with a definition of that, again, in that ruling that I highlighted up the top, tax ruling 2013-5, that the trustee has a liability to make a series of periodic benefit payments that relate to each other over an identifiable period of time. Now, why do I put the emphasis there? Well, it means, the main reason is because I previously said that we can pay annual pensions. Now, if we pay annual pensions, you're going to need at least 2 years to have a series, right? So you can't commence a pension potentially just prior to 30 June 2023 and then commute that pension without a further payment in July 2023. You might have been doing that for transfer balance cap purposes. If you haven't made that additional pension payment, then you would argue that there is no series of payments occurring. So it's pretty critical, particularly those that started in June and maybe didn't pay a minimum, that if they then do take their pro rata pension in this year, that they're probably not going to have a pension if they then stop that pension after that one payment. So it's an important fact or an important point to understand that you do need a series, even when we're talking about annual pensions. Importantly and strategically, this is where it's quite valuable that every pension is its own separate interest. So strategically, that's really good from an estate planning point of view, but also, the whole concept of tax-free and taxable from an individual position as well, but also from a TRIS point. And I'm going to touch on transition to retirement pensions as well, and highlight that, if you've got someone with unrestricted non-preserved benefits and potentially with preserved benefits, that there is capacity to create separate interest resulting from the payment standards and the payment priority requirements, which I'll work on or work through with you when we start talking about transition to retirement income stream. So having that separate pension interest is of value, particularly, and I think more so largely in the SMSF space, because it does allow for particularly those blended family situations for us to run multiple pensions. But the caveat to that is, if you get it wrong, then a lot of that work can be undone, and you end up merging all your money back into the accumulation interest, or indeed the client ends up merging all their interests back as to one accumulation. And then the other thing that the tax office talk about often, or do talk about in that ruling, and something that's pretty critical within the administration space is, when does the member request to commence their pension, and has that request been received before the first pension payment is made? Now, again, in the SMSF space, we're talking about the direct relationship between the member and trustee, and so the lines of application can be ultimately blurred. But what we need to try to encourage as much as possible for our clients is that they are making the request to themselves, they are documenting the request, and even if they haven't got member balances yet, so 1 July is the classic example, where what are we, 18 days into July, and there'd be many people that, most people, if not all people, don't have their super fund valuations at 30 June 2023 completed yet, but they have put in a request to commence an account-based balance, an account-based pension. So in that instance, they're not going to know how much that pension is commenced for, but they've at least made the application prior to that first payment, so they can start to draw down. And then from an administrative point of view, they can update their paperwork later, but they've still got restrictions when it comes to such things as the transfer balance account. And that's a good, I guess, segue into the next element, and that is that from the 1st of July this year, we have a situation where all self-managed superannuation funds are going to go to quarterly transfer balance account reporting. And so what we have to make sure is that regardless of whether a pension commenced in the last financial year, or whether it's commenced in this period between 30th of June and the 30th of September, that they get all their reporting in by the 28th of October. So that's really applicable to all of those funds out there where they were previously under the annual requirement and they would have normally lodged with their annual return. They have to make sure, because we're all moving to quarterly, so regardless of thresholds, so at least removed one total superannuation balance threshold, that all reporting is done by the 28th of October. But further to that, and we've passed this date, is that because of the indexation of the general transfer balance cap, we've got the indexation of personal transfer balance cap, and the ATO should have now already, based on their previous advice, updated the displaying of that personal transfer balance cap. So the calculations took place on the 1st of July, and they said by the 11th of July that all people's personal transfer balance caps would be updated. But of course, that will again be amended if we subsequently do our reporting up until the 28th of October for any transactions that occurred last year or in the prior to 30th of June. And that's a pretty key issue to be mindful of, is that from a reporting point of view, we really need to try as much as possible to encourage early as possible reporting, because of the ramifications it can potentially have from a client point of view. So that's the concept of the personal transfer balance cap, general transfer balance cap, following on from the whole idea of commencing a pension, and when and how do you commence the pension, and what are the various requirements. And so by mentioning the general transfer balance cap, what I would highlight there is that we now know that it's gone up to $1.9 million, and we've then got our non-concessional thresholds that we can use as part of that, and our bring forward amount. Obviously, the lower balance, the lower threshold balance to be able to use the full 330 has increased. And what that creates for us is a lot of strategic opportunities. So there might have been clients previously, before, in and around that $1.6, $1.7 million who were ineligible to make non-concessional contributions. Now they can look at, with the extension of the contribution rules up to 75, now they can look at their own strategies from a rebalancing their tax-free and taxable components. They might be doing that from an estate planning point of view. They might be looking to rebalance accounts between spouses. So again, you might have the spouse with the high account balance, and then the spouse with the lower account balance. So there's all sorts of things that will be considered as part of the move in the general transfer balance cap to $1.9 million. But further is, of course, the capacity to maximise the exempt current pension income. So we might have a pension account, an accumulation account, and we're going to use the general transfer balance cap indexation to be able to maximise as much of the exempt current pension income for our fund as we possibly can. So there's a whole heap of things that we would consider there. And if we're looking at the recontribution strategy, well, that would then lead us into the obvious question, which is, where are you going to take that money from? And of course, one of the questions that we would have to ask our clients in each set of circumstances is, are you going to take it as a lump sum withdrawal? Are you going to take it as a straight out pension payment? Or are you going to take it as a commutation from one of those pensions? So lump sum from accumulation, commutation from a pension account, or just as a stock standard pension account. And of course, from a priority point of view, we would always say satisfy the minimum pension first. So we would always say pay cash, make a cash payment first, right? And then that's going to meet our pension obligations. So we know from a 107D requirement that if we're taking a partial commutation, then we have to have sufficient cash or sufficient liquidity left in the fund to ensure that we pay the minimum as calculated on the 1st of July each year. So that's our requirement there. If we take a full commutation, we know that we have to do a pro rata commutation, or pro rata minimum, from the 1st of July up to and including the date of the commutation. So strategically, the use of commutations and the use of that withdrawal strategy is significant, and it's really important that our clients look to document those decisions, and often they should be looking at that from right out from the establishment point, that when they're setting a pension up, they might want to put in to the pension rules, they might want to put in conditional cashing requirements. So they might say that we choose to take the minimum pension, and then we will make an election for any payments above the minimum as to where that money comes from, or they might be quite specific in that commencement documentation as to the choice of action that they're going to take. But again, you wouldn't want them to be too specific in the initial documentation, because their circumstances might change and they want to have that discretion as to how to treat the payments in the future. So priority one is obviously always to treat the payment as a pension, and beyond that to make the determination prior to the amount being paid out as to what they're actually going to do. So strategically, there's opportunities still there, and that's what we should be doing from a planning point of view now with all of our clients. Is we should be contemplating what are the opportunities this year. Are we commencing pensions? And I suspect there is a lot of pensions that are commencing on the 1st of July this year. If there are, what are we doing with regards to any existing accumulation interest? And what are we doing with regards to any amounts over and above the minimum pension? So all of these sorts of things form part of the pension planning and ongoing maintenance requirements, which then leads us to the key issue of when a pension ceases. Because there's the obvious times when pension ceases that we're very clear about, i.e. when we run out of money. But then there are other sets of circumstances when the pensions tend to cease as well. And we've got, again, from that ruling 2013-5, we've got a number of good examples of things with regards to, I guess, some of the more obscure times that a pension ceases. And one of those is when it fails to meet the pension standards. So when we go through the standards that I talked about before, paying the annual minimum, no adding capital, meeting the commutation rules, when you fail to meet those standards, then the commissioner says that pension has ceased. Now, in most circumstances, that pension has ceased even though the fund has continued to make pension payments. And so that then creates the dilemma for many of us of how do we treat those payments. So that's one set of circumstances. If we fail to meet the conditions, then we've got a problem for our fund. And then the other one is, so we've got the minimum requirements. If we fail there, if we don't meet the pension standards, if the member dies and we don't have a reversionary pension in place, then the pension will also cease, and we have to make certain decisions there. That then has its own flow-on effects, where if the member dies and there is a reversionary pension, then we've got to make sure that the minimum pension requirements are met again from that point. So there's all these sort of ramifications of those pension standards and what it means from the client with regards to if the benefits have continued to be paid, what the requirements of the super fund are. So, if we look at a situation of an example, and I've modified the example from the original ruling to bring it up to date from a year's point of view, given that it is a 2013 ruling. So we've got Bill, and he commenced an account-based pension. His minimum pension was paid for the 2020, 21 and 21, 22 years. And then the start of the 22, 23 year, the reduced minimum was $50,000. The fund only paid $5,000. Now, that's a fairly significant level of underpayment in that instance, but it's not uncommon to have funds who don't set up periodical payments, and they just regularly go about the business of transferring money at the end of the financial year, and they may have some sort of circumstances that mean they haven't made that annual payment, and that can be problematic for the fund. But in this instance, in Bill's instance, the amount that's been paid is less than the minimum requirement, and therefore he's failed to meet the minimum requirement, and as such has failed to satisfy the pension standards. So in this instance, the pension will cease for income tax purposes at the beginning of the financial year, so from 1 July 2022. And that $5,000 is going to be treated as a superannuation lump sum. So this is the ATO's position with regards to the cessation of pension from an exempt current pension income point of view, but also saying that you don't meet the definition of what the fund or what the fund needs to meet to be a pension. Now, in this situation, if this is an account-based pension and Bill is over the age of 60, then from Bill's point of view, treating that $5,000 as a lump sum withdrawal is neither here nor there. But from the fund's point of view, it obviously has the ongoing flow-on effect of losing the exempt current pension income. Now, again, if you factor that in from a compliance point of view, there's no compliance issue with failing to pay the minimum, but the tax implications can be significant if Bill's fund went through the process of selling down some large CGT gains in the year, and now we have to go back from a point of view of saying, okay, well, there's no ECPI, so all of those gains are going to be taxable. What is the end tax game for the superannuation fund? Now, the ATO's position here again is that if you then pick up in with your payments from the new financial year, then it's the commencement of a new pension, and you're then going to have to go through the requirements to report the pension and undertake take whatever other action is necessary. And of course, if you had accumulation interest in the fund, then as far as the ATO are concerned, that has rolled back to accumulation and merged in with your other components. Now, this is kind of the kicker to all of this, is that the pension ceases from the 1st of July 2022, but from a transfer balance count point of view, it ceases at the end of the year. And this anomaly, I think, is one that we all sort of struggle to get our head around from a reporting and a timing point of view, because what that is then implying is that the tax-free and taxable components, in theory, should be fixed right up until 30 June 2023. And then you would start your pension. But because you've got that rollback, if you roll back into an accumulation interest, and even if it's only there for one day from a reporting point of view, it's going to create a blending with any sort of taxable and tax-free components you have in that interest. So this is one of those areas that you just need to be mindful as to what approach or what outcome will it impact if that money has to go back. But you've got an ECPI date, which is 1 July, and then you've got a T-bar date, which is 30 June, and that can be problematic. As I said, treating it as a lump sum payment is less problematic. Gaining or requiring the ECPI or losing the ECPI deduction is problematic, but then potentially you've got other issues such as Social Security, and if they had grandfathered pensions, then ceasing the pension would potentially lose the grandfathering and therefore revert to a deemed pension rather than a deductible amount pension, and also may have ramifications from a Commonwealth Seniors Health Card point of view, where the pension was previously exempt or the income was previously exempt, and now the assets are going to be deemed again from a Commonwealth Seniors Health Card point of view. Not that from a Commonwealth Seniors Health Card it's that significant as much as, say, the age pension elements, because the thresholds now for the Commonwealth Seniors Health Card are fairly significant when you apply the current deeming factors, at least until 30 June 2024. The deeming rates mean you can have a fairly significant balance in super and still be eligible for the Commonwealth Seniors Health Card. But again, it's the sorts of ramifications that you want to try and avoid where possible. So the question that's often asked is there relief? Like, what sort of relief is available where there is a minimum pension shortfall? And the ATO have given us, I guess, what we can consider very minimal or very small window of opportunity for the first time that a self-managed super fund breaches the minimum pension requirements. And that small window of opportunity is if the shortfall is less than 1/12 of the annual minimum payment and they're a first-time offender, then you can effectively self-assess and catch up the payment as soon as practically possible, which they say is within 28 days of becoming aware. This is always that quandary in the SMSF space, is what is that 28 days? When do you become aware? Well, in theory, as trustees, you should be aware from the 30th of June that you failed to pay the minimum. So realistically, from a structured or applying the law to your clients and talking to them, you really want to make sure they get that catch-up payment done before the end of July, to just not have to do a please explain from a regulatory point of view. But if you don't meet that 1/12, and if you don't meet that first-time offender rule, then the reality is that you have very limited circumstances to be able to apply any sort of discretion other than going to the tax office directly. So if you're not eligible to apply those those principles as I've just discussed, then you have to write to the ATO and seek effectively their discretion to say that the pension did exist. Now, I've got a couple of examples there of someone that went through incapacity, a trustee who was overseas, but they may in that instance need to provide further sets of evidence, and then the transposition errors. Now, what I would say in those sets of circumstances is beware that the tax office feel that from self-managed super fund point of view, these issues are far less relevant or far less likely to give you that discretion than in an APRA fund, particularly with something like a transposition error. Now, if it's because you've provided the right info and the bank has made an error, then sure, I think you're going to get across the line with regards to that one. But the only set of circumstances that, and maybe this is luck on my behalf or that I haven't been sort of confronted with too many issues in the last few years, but one where I did find the commissioner gave relief to was a fund where the member had their money in an APRA fund. I think it was an industry fund. I can't remember where the other fund was. And they had an account-based pension, and they commuted that pension during the year, and they paid their minimum from the pension, and they paid the full year's pension from that industry fund. And then they rolled their money into the self-managed superannuation fund, and then they didn't take any more pension, right? So they actually hadn't taken any income for the entire year, and it had ECPI ramifications. Now, in that instance, and this was actually quite surprising to me, but in this instance, the ATO actually provided them that discretion and gave that or allowed them to still claim the ECPI deduction because of that misunderstanding or misinterpretation, but because they'd drawn enough money, meaning the value of the rollover was less than it probably should have been. Now, I would never say to anybody that you're going to guarantee success in that sort of set of circumstances, but the issue here was the client actually approached the tax office and the client went and sought that discretion. So you don't know if you don't ask is really the moral of that story. And so I would always say if there's a set of circumstances where the trustee has failed to pay the minimum, then the first port of call, if it's above that 1/12, and a lot of the minimums are going to be, is to go to the ATO and see what sort of discretion they might be willing to apply. As I said, not suggesting that it's going to happen in every set of circumstances, but I've seen it apply in the situations that I otherwise wouldn't have expected them to apply. So again, to reiterate the ramifications, then you might see that we're going to have the unwinding of our multiple pensions, and that can be problematic. Loss of grandfathering, but also market valuations. So if we're having to stop and restart again and the markets have increased, then do we have a limit on what we can put back into pension from a transfer balance account point of view? So all of these sorts of things that you've done all your diligent planning with upfront to ensure you avoid any excess T-bar, to minimize or to restrict or to isolate your tax-free and taxable, can all be undone. Now, that poses the question, okay, well, if we're talking about multiple pensions, and I still think multiple pensions are one of the great strategies with regards to not just estate planning, but again, I also think it's a great strategy with regards to minimizing the risk of failing to pay the minimum pension, is that the tax office have, in their examples from their page about paying the minimum pension, they sort of say that if you have two pensions and you meet the minimum for one and not the other, then that one that you meet satisfies the condition, you only lose the exemption on the other one. But they also say if you've drawn more money than the entire minimum, but you've drawn it all from one pension account, right, then you can't just automatically assume that you can apply that minimum to the second pension account. So again, I think this comes back to using that piece of advice from the tax office to your strategic advantage to make statements when the pensions are established, to ensure that you've got payment instructions that state, in the instances of having multiple pensions, that any withdrawal from the fund will be allocated on a proportional basis to ensure that each minimum is met, and then a further instruction as to how to treat payments in excess of the minimum. So, again, coming back to the wording and how we identify the rules around each pension is going to be critical, because One worst case scenario is we're going to lose the exemption for one of the pensions, but on a best case scenario, we can work past the ATO's position or their stated position about multiple pensions and one member, and we can allocate the income across, or the income withdrawals across all of those pension accounts. But I think again, there the key is going to be in the way that we document our pension documentations from an annual requirement. So a couple of things for us to think about there strategically. Now, what I want to jump into then as a follow-on, and of course, normally a TRIS would follow or would do before the account-based pension, but I wanted to work through those pension standards first in a stock standard set of requirements. But now let's jump into the TRIS issues, because the TRIS issues are actually far worse in one set of circumstances than the account-based pension issues. But on the flip side, from a fund tax point of view, they're less of a concerning issue. So what we know from a TRIS point of view is we know that the positive elements of the TRIS is that we can create separate superannuation interests, and right now we can do that from age 59. So we've got our preservation rules that mean we don't have to have ceased work to be able to start to split our benefits into those separate pension interests, and that's been confirmed multiple times by the ATO. We can therefore do our proportioning of our tax-free and taxable components from that point in time. So a real positive measure there, again, going down that multiple pension stream. It is treated as part of the accumulation phase, right? So it's a members accumulation phase. So therefore, until there are nil conditions, until we've satisfied nil condition cashing requirements, we're not counting it against the transfer balance cap. So again, this is where we've got situations where we can actually look to use transition to retirement income streams as a way of reducing balances prior to hitting that retirement stage or hitting age 65 or whatever it might be. We can use a TRIS to start to diminish a member's balance to get us back to the transfer balance cap. So we can then, at that point in time that we meet a nil cashing restriction condition of release, we can then potentially put more money into the exempt current pension environment. So, again, strategically, TRIS have an important part to play there. The flip side, the downside, is that we don't get that earnings tax exemption. And then the double flip side of that is that, unlike an account-based pension, because our money is preserved, we don't have the ability to do in specie transfers out of the TRIS account. So in account-based pension, if we want to take a lump sum and we want to transfer assets, there's no problems there. But from a TRIS point of view, we can't do that, and all pension payments must be made in cash. We've then got the other side of things, which is a positive and a bit of a negative in my opinion there, but we do move to retirement phase once we satisfy a nil cashing restriction, which is our retirement, our disability, or attaining age 65. There's also then death for reversionary pensions. But the key thing there is that's a little bit about timing. So from a membership point of view, pre-age 65, we know that the change from accumulation phase to retirement phase occurs when the member advises the fund that they have retired. So that gives us an element of time to move that across to ensure that we don't have any excess transfer balance cap issues. On the flip side of that, 65 is a hard and fast date. And so if we haven't made any adjustments to our TRIS to bring it below the general transfer balance cap from our 65th birthday, then we're going to have an excess transfer balance count, and we're going to need to do a commutation anyhow. So we just need to be proactive for our clients hitting 65 to ensure that we're reviewing their funds to identify where there's an opportunity to commute prior to their 65th birthday. And the other thing is that we've got this priority cashing rules, and I mentioned that a little bit earlier. And what that is that in a TRIS account or from a fund in general, our requirements are that we must take benefits from our unrestricted non-preserved benefits first, then our restricted non-preserved, if they exist ever in any set of circumstances these days, and then finally from our preserved components. So if we've got a TRIS and we're operating that TRIS and we've got some unrestricted non-preserved benefits because we've met some other condition of release, then we know that every pension payment that comes out of that TRIS is going to come from the unrestricted amount first, but all the growth in that TRIS is going to be attributable to preserve benefits, because that's how the preservation works with regards to investment earnings. So you've got these considerations or these issues to be mindful of. And if we touch on the strategic elements of TRIS and where there are opportunities available to us, you know, the opportunities are probably not as much as they were before 2017 with the introduction of the transfer balance cap, and you could probably even argue that not so much as they were before 2007 even. But because we lose that asset test exemption, that tends to be the reason why a lot of people turn off or turn away from TRIS, but also the low concessional contribution cap. But if we take a snapshot of the SMSF industry and we identify that there are a significant number of funds still with less than that $500,000 transfer balance account, or in and around that general transfer balance account, and if we look at a TRIS, for example, where the maximum is going to be 10%, and so we might have someone around that $500,000 mark or just over, then they might be able to take a significant enough withdrawal to get them under $500,000 at the following 30 June to be able to potentially utilize any concessional catch-up contributions. And so, you know, just as a bit of a guide, and this is really just an example of someone that was earning in comparison, getting about $10,000 worth of superannuation guarantee back in the 18-19 year. And what this table really highlights is that they've got their super guarantee amounts being contributed, and many people in these instances are potentially unlikely to have been making additional salary sacrifice, but if they have, then that's obviously going to limit this strategy. But each year they're going to have their general cap, or the general concessional cap, but they're going to have their unused cap. And so even though we're losing the exemption on the fund from a TRIS point of view, we might be able to be in a situation where we can really salary sacrifice quite heavily and then claim that personal tax deduction to offset that via using the concessional catch-up strategy. So I still think there's a lot of merit in using transition to retirement income to offset the personal tax liability for clients. And to go one step further with the strategy, and this goes back to my cashing restriction comments before, is if we look at this account here and somebody sets their TRIS up with $600,000, right? So we now know that we've got no exempt current pension income on that TRIS, and we also know that of this $600,000, every drawdown, so their 4%, is going to come from their unrestricted non-preserved balance. So that $300,000 preserved is going to increase, and that $300,000 unrestricted non-preserved is going to decrease. But if we go, okay, why don't we split that, and why don't we look to run it as two pensions? Then again, the cashing requirements say, one, you can't choose tax-free and taxable, so that's fine. We can't split our benefits, but what we can do is, under the cashing priority requirements, is we can commence our first pension with $300,000 worth of unrestricted non-preserved, and we can get effectively in this fund situation, a 50% exempt current pension income deduction for the fund. And then we can also start up a second TRIS with that preserved amount of $300,000. And we know that the growth on that will all be preserved, but we know that the growth on the unrestricted non-preserved fund, because it's met that nil cashing requirement, then all of that growth will be unrestricted non-preserved. So there are certainly benefits, again, coming back to that multiple pension strategy that I had talked about before, when we set up TRISs, because we've got the ability to potentially, one, look at it from a estate planning point of view, but two, also if we've got unrestricted non-preserved benefits, we can look at maximising that as well. So yeah, there's a lot that can be taken into consideration with regards to that. So if I then move on and look about what happens when we fail a transition to retirement income stream, this is where things can be problematic, because not only do we have the minimum pension issue with a TRIS and failing to pay the minimum, but we also have the maximum limit. So we have our 10% limit, and that can ultimately result in illegal early release. But even if we fail to pay the the minimum and we're going to treat those amounts as lump sum withdrawals as per the ATO's previous instruction, well then if it's accessing preserved benefits, is it going to fall under the classification of illegal early release? Now, failing to pay the minimum, I suspect you may get more leniency from a response from the ATO, not guaranteeing it, but I'm saying that there might be greater capacity to work with the ATO there and not get too harsh a penalty. Not saying that the income won't be taxed at marginal rates, but it may be less of a compliance problem for the fund. But if you go over that maximum, then the tax officer definitely more likely to take a more hardline approach. And so this is where the tax office a couple of years ago released two sort of supporting documents. One, an internal document, the PSLA 2021 D3, and then one, the public document, TD 2021 D6. And both of these talked about early release of superannuation and the ramifications for that early release. Now, what they talked about in there is they said, well, really ultimately, how much control do you have over this early release factor? And that will determine whether or not we will treat the income as normal taxable income in your fund, regardless of whether it's tax-free or taxable. We'll treat it as taxed at your marginal tax rate, or we'll take a different approach. Now, in May, I think it was, the ATO came out and said they're not ready to finalise these documents. So at this point in time, we need to be mindful that the ATO's draft position is that if you go over the maximum, then one, you're definitely going to have income that is taxed at your marginal tax rate. Two, you've got illegal access of preserved benefits, and because you've gone over that maximum, that's definitely going to have some form of ramifications. But three, you're kind of in a bit of a holding pattern because you don't have a definitive position from the ATO. Now, what they did in this ruling, and in these rulings, they provided examples, but most of those examples, as this one here highlights, were referencing an APRA fund and what the circumstance would be. So in Donald's situation here, the Muscovy Super Fund is a regulated fund regulated by APRA. He commenced a TRIS with a maximum amount of $75,000 to be paid annually. He asked the super fund to pay the maximum pension payment to his bank account in June each year. And then in June, the super fund, the APRA fund, overpaid by $10,000 because of a system error. And because he's past his preservation age, but not met any other condition of release, he was allowed, the only cashing restriction was a TRIS, right? So that's the example that the ATO have basically put in these rulings. So they've focused on an APRA fund making a genuine or a transpositional banking error. Now, in this instance, they said this was out of his control. So he didn't have control of the situation, and therefore it wasn't going to be taxed or wouldn't be a breach of the payment standards and would be taxed in accordance to the normal pension rules. But what we're looking for is what is their position with regards to self-managed superannuation funds. And the reality is that the tax office have sort of basically come back and said in their initial planning and an initial sort of wording around this is that self-managed super fund members have far greater control and therefore are far more likely to have the full letter of the law applied to them with regards to not providing discretion and therefore being taxed as taxable income. So we just need to be really, really careful of that. And the SMSF Association, we know they made their submission to say that we need more examples in these documents that support self-managed super funds, or at least provide us with greater clarity as to what your position will be, so that we can communicate this with our clients. So ultimately, if we fail to pay the benefits under a TRIS, and just further to that, I'm going to, as I finish off today, I'm going to finish with this case example that I talked about, which wasn't a TRIS as such, but it shows the potential ramifications of getting things wrong. So what we know from a TRIS point of view is if we fail to meet the minimum pension, then the pension ceases at the start of the year, and all payments will be treated as a lump sum, and they're going to be taxed as assessable income unless the ATO apply their discretion, and that's a big if. But the following is not going to be impacted. So there's not going to be any loss of ECPI. So, the fund's already in an assessable, a taxable situation. So there's no loss of ECPI. So that's not a problem there. And there's no TBAR reporting requirements. So we might have to think about whether we're going to start up a new pension following the 1st of July in that sort of circumstances. but there's obviously no requirement necessarily to do that. So, the whole rules around TRIS are still problematic, but from a fund point of view, they're less of an issue. They're far more of an issue from the member point of view versus, say, the account-based pension for someone over the age of 60. So a lot of these strategies that we introduce are then factored towards the estate planning side of things for our clients. And so it's important for us to recognize what are the ramifications if, from an estate planning point of view, we tend to get things wrong. Now, I said right up front that with a lot of these rule changes that we have to consider whether or not a reversionary pension is the right tool for our clients. And it's this whole minimum pension obligation that's always had me sitting on the side of the fence to say that in the vast majority, and maybe I'm overstating it by saying the vast majority, but in a relatively high proportion, I would think, of self-managed super funds, discretion is not a bad thing, because with discretion from a death benefit pension point of view, you've got the capacity to say, okay, well, let's just take stock, work out what we're going to do, and determine if we're going to pay a pension moving forward. If we do that, we retain the exempt current pension income for our thinking period, right? So if we have the member pass away and it takes a couple of months to make that decision, the exempt current pension income continues. Yes, we've got no minimum pension obligation prior to the date of death, so that satisfies any failing of the minimum pension obligation. The caveat being that, of course, the transfer balance account is going to be based on the valuation when we commence the pension, and it's reported and effective immediately, versus the valuation at the date of death being applicable for reversionary pensions and it not appearing on the transfer balance account for that 12-month grace period. So it gives you more capacity to plan around other pensions in a reversionary sense, to whether you're going to commute the spouse's benefits or whether you're going to take lump sums or commutations from that reversionary pension prior to that 12-month anniversary. So it swings and roundabouts. There's benefits of both that we need to be mindful of there. But with the minimum pension obligations, the key issue is that there is no minimum obligation in a discretionary pension. It's just a pro rata obligation from the day that we start the new pension for the surviving spouse. So it does have some positive ramifications. When we look at reversionary pensions, what we need to be mindful of there is that we've got that minimum pension obligation that applies throughout the entire period. Now, previously, the ATO gave some guidance where they had some leniency towards reversionary pensions if the minimum pension had failed. Now, subsequently, they've removed that leniency from their website, so having access to it is not necessarily possible. But what they have done is they have gone to the step of saying, okay, well, with the cashing requirements, the death benefit has already been cashed. And so in theory, if you fail to pay the pension, then you failed to meet those pension standards and the benefit has to go out of the fund. But they've effectively created a separate set of leniency rules here where they've said what you can do potentially is recommence a new pension immediately for that reversionary pension. Now, I say potentially because it's not with any absolute certainty that we have this position, as was previously stated by the ATO. So it's pretty critical, if you have a reversionary pension, that we put as many mechanisms in place to ensure that that minimum pension is continued to be paid. Now, the problem being that I see most of the times with these pensions is that inevitably, like the prime member of the fund, the person that made all the decisions, is the one that dies first. Now, when that happens, and let's say they pay themselves annually, they knew to transfer the money at the end of the year, whereas the surviving spouse wasn't privy to that decision, or more to the point, just didn't take much notice of that decision, because they should always have been privy to the decision. And so therefore they failed to make that payment. So to apply these conditions and to potentially start a new pension, right, which would then require different TBAR reporting from a new pension date rather than the date of death, then what I'd be saying is, similarly to the failure of the minimum pension, the first place to go to me is the tax office. So you go to the tax office in that set of circumstances and, well, firstly, again, see if the shortfall requirements apply. So if it's less than 1/12, apply that set of conditions. But other than that, I would be going and seeking the discretion from the ATO to determine whether or not there is an opportunity to retain that existing pension. Otherwise, the payment would be treated as a lump sum. So look, what I want to finish off with today, and then if anybody's got any questions, I'll throw it open to the floor, is I just wanted to take you through very briefly this case that was put out in the public sphere in April this year. And the fund is, well, the client is WZWK and the Commissioner of Tax. Now, what we have is a situation here where WZWK, to give you the full position, was a tax agent. They were an SMSF auditor, and they were in theory an SMSF specialist with the CAs. Now, therefore, the tax office, and I've got that reference down the bottom of the page there about the ATO tend to hold professionals to a higher standard. This accountant / advisor / auditor had a self-managed superannuation fund, and in 2010 established a new self-managed super fund. Now, if you go back 2 years before that, he set up a secondary business and had that secondary business make contributions to the superannuation fund. Total contributions were $20,000 to that self-managed fund. His employment with that second business, so of course it was his own business, but that employment with that second business ceased in October 2010, so a number of months after setting up the self-managed super fund, the second self-managed super fund, which conveniently had contributions made into it. The company ceased because there was a fire and the building was damaged, and he said it was too hard to continue on with the business. So took that as an opportunity to apply a condition of release, and that condition of release is if you have ceased gainful employment, right? So it's not whether you're age over 60 or whatever, but if you have ceased gainful employment and that employer has contributed to the superannuation fund, then you can pay yourself a lifetime pension, right? So there is a restricted cashing restriction that says you can pay a lifetime pension. So he started to pay a lifetime pension out of his self-managed super fund, and from 2010 through to 2016, drew over $800,000 for the fund. Now, the beauty of this fund is there's so many other breaches of the SIS Act and the investment restrictions and investment requirements that it's a case study that can take hours to talk about. But because the valuations of the assets that he was doing, the market valuations of himself, the fund went from being valued at next to nothing to up to, I think, about $8 million over that 5-6 year period, which then he was applying the minimum pension factors to draw down amounts that got him up to that $800,000 limit. So his argument with the tax office was that I'm entitled to pay a non-commutable lifetime pension from the fund. The tax office's argument was that since 2006, self-managed super funds can't pay lifetime pensions, and even if you did, you weren't paying it under those conditions of how you used to pay lifetime pensions, because this amount is not fixed and only indexed in accordance with CPI. You're taking it under the account-based pension rules, and you're effectively just early accessing your fund, to the point where he early accessed the entire value of the fund because the valuation subsequently, not surprisingly, came down, and then in 2018, 2019, it was worthless. So what the tax office did in this instance was they started to audit the fund, and they basically said that all of that income was illegal early access. So you claim it to be a pension, we claim that it's not a pension, you haven't met the condition of release. And so not only is the fund non-complying, and here's the penalties for that, all of the income will be taxed at your marginal tax rate, and you'll also then have additional tax penalties to pay. So as you can see there, breached sole purpose test, breached financial assistance, breached other things, related party acquisitions, and also had an issue where they breached the payment standards and the preservation standards. So pretty significant case. And I find it interesting that it came out from a compliance point of view at the same time that the ATO are further investigating the issues associated with not paying the minimum or paying more than the maximum. So it just reiterates that point to me that there is a problem. So as the key takeaways, from today's session is that we've got lots of opportunities, and I think the indexation of the transfer balance cap provides us with those opportunities from a strategic point of view with our funds, multiple interest, recontribution strategies, all of those various strategies that we can use, and we can use them from a TRIS right up to an account-based pension. But when we then fail those pension standards, there are going to be consequences, and those consequences from a fund point of view can be the loss of the ECPI. From an individual point of view, it can be that income is taxed at marginal tax rates. So be mindful of how those rules apply. And if you're doing it from a TRIS point of view, it's going to be even more problematic because you've got the maximum, not just the minimum. Also, in the ongoing forever debate about reversionary versus non-reversionary pension, the minimum pension obligation doesn't exist where discretion does, whereas for a reversionary pension it does. So it can be a little bit more problematic when that second spouse doesn't pay the pro rata income for the year. So look, that brings me to the end of today's session. I'll leave that open for any questions if anyone's got any. Hold that open there for a few more seconds. If we've got no questions, then I just want to say thank you for attending, and we will issue the CPD certificates ASAP with a copy of the slides from today. So thanks very much for attending, and look, I hope to see you all again probably next month. Thanks a lot.